on this page is talk just a little bit, before we get into some accounting detail, about some of the foundational principles that this is really all about. We've introduced these already, but let me just give you some terminology, some ideas that are kind of being embedded in the program. That first thing up there says GAAP. Now you might think if you were going to say that word, you'd say it GAAP. But actually you have to put that extra A in there. It sounds a little bit like a sheep or a goat. So let's just all do it together. GAAP. GAAP. What does GAAP stand for? Okay, good. Write that down. Generally accepted accounting principles. That's right. Generally accepted accounting principles. Now, generally accepted accounting principles, we're not going to really go into a lot of depth in this class about generally accepted accounting principles, but they're extremely important. Generally, what are they?
Rules.
They're the rules. They are rules and guidelines for the accounting game. Good. And why does the accounting game need rules and guidelines? That's really the second question, I think, on your sheet there. Why does it need rules and guidelines? Consistency. Good. So you compare one period to the other, different companies with each other. Okay. Structure. Continuity. Standardization. Excellent. Okay. And the other two words I want you to write down there is fair and objective. Because what we want these statements to be, and we've already said it, is we want them to be fair and accurate reflections of the health and performance of an organization or a company, right? Because sometimes can these things be used to deceive? Can they be used to say things different than what really happened? To, I don't know, shareholders or company owners, right? So we have all sorts of these rules that have been tightened recently. There's been some legislation that rolled out about 5 years ago, beefing up Sarbanes-Oxley. Have you guys heard of this rule? About different separations of responsibilities and different reporting guidelines, all for the purpose of tightening up and make sure these things are fair and accurate reflections. Now, I'm not going to talk about too many generally accepted accounting principles in here, but I am going to talk about one, and it's the third item on your page. It's called the matching principle. Anybody have any idea what the matching principle is all about? The matching principle. Okay, that's fine. Good. Yes?
Activities that happen in one period of time have to be recorded in that period of time?
Okay, good. That's close. That's excellent. That's an aspect of it. Okay, now, the income statement. We want that to answer what question? Are we profitable, right? Well, sometimes in a business, there's a difference between when the money is spent and when the actual revenue comes in. And it gets hard to answer that basic question if you're just looking at cash flow, right? What the matching principle says here, and I'd like you to write down, is that expenses need to match the revenue they create. And it's a timing issue. Expenses need to match the revenue they create. So we can accurately state profitability. Now, sometimes certain businesses, the way the cash comes in and goes out does match when we earn the revenue and when we pay the expenses. We call those types of businesses cash businesses. Cash accounting is basically revenues recognized when we get paid or make deposits. Expenses are recognized when we write checks. And if both of those things occur in the same accounting period, we're fine. The world is beautifully, simply elegant. If we don't sell on credit, if we don't buy on credit, and we don't have inventory, and we're primarily a cash business, cash accounting is beautiful for a number of reasons. It's simple, and our cash flow statement and our income statement are basically the same statement. Does that make sense? How many of you all work in businesses like that? You don't buy on credit, you don't sell on credit, and you don't have inventory. Raise your hands high. If you are, you have a business very similar to Missy's Lemonade Stand in Kodiak, Alaska, right? Where Missy, at the end of the day, can tell the difference between her cash balance at the end of the day and the beginning of the day. That's how much money she made. After she paid her extensive staff, her logistics, her delivery guy, she got her lemonade all made and she sold it for 50 cents a glass. The rest of us, though, have to use a much more complicated form of accounting to adjust for those timing issues. That's called accrual accounting. In accrual accounting, revenue is recognized when it's earned, and expenses are recognized when we actually incur them or incur the liability for them. Also, as part of ramping into the growth of Mary and I's training business, had the opportunity to teach one cycle of small business management for the Small Business Development Center in Grants Pass. That was a fun experience. That's where I get 9 businesses for a period of 9 months, and we teach a class, and then I'm able to go and meet with them and understand, how their businesses are working, and we do a little consulting thing and coaching thing, and try to actually improve not only their financial acumen, but also sales and marketing and all sorts of other stuff. How many of you all are familiar with the Small Business Management Program? Wonderful program. Those of you that aren't, I highly encourage you to check it out because some really good training, really good resources at not much cost, all right? And usually the folks that teach those programs have good business experience and a lot of great stuff to share with you. But I was getting up and going with this segment of it that I was teaching right in the very, very beginning. And one of the first things I do when I sit down with the different businesses is I take a look at their last 6 months of financials. Now, we sign this non-disclosure, and it's all confidential and all that kind of stuff. So I sit down with a floor covering guy, not going to reveal his name, nice guy, and we look at his January results. His January results report that he lost $30,000. I say, dude, what's going on? Literally, that's what I said. Dude, what's going on? I said, don't worry about it. Don't worry about it because I've got this big job going on and I had to pay my people and I had to buy some carpet and stuff like that, but I haven't got my first progress payment yet. It's coming. And so we look at February. February, he lost $40,000. And sure enough, we get out to March and he shows this big progress payment of $150,000. And everything kind of settles out on a year-to-date basis and it looks great. And then we proceed and it's lumpy like that. Now, what's the problem with that? It actually is measuring cash flow. Okay, he was using cash accounting when he should have been using accrual accounting. See, what he should have been doing from a profitability measurement perspective is comparing the activity that he was putting in, including material costs and paying people, with the amount of revenue he'd in fact earned in that same time period. So if he needed to tweak his decision making, he could have done it early on in January and February, instead of waiting until it all evened out in March. You get the issue? Okay. A lot of people, because of the simplicity of cash accounting, they do cash accounting in QuickBooks when they in fact should be doing accrual. Now, so we have accounts that get created in accrual accounting that don't exist in cash accounting. And I'd like you to write 3 basic operating accounts down next to accrual accounting that get created. What type of account is it where you hold material costs until you actually turn them into product that you sell down the line? You guys, somebody mentioned it up here. Inventory, good, write down inventory. Inventory gets created as a place to hold material costs that will turn into product you'll sell down the line. Okay, now, where do those balances get hold of, those IOUs that people owe you from buying your stuff on credit? Accounts receivable, write that down. That's where you hold those balances. Because you see, in an accrual system, you're going to record that revenue when you've earned it. But if you haven't paid for it yet, you're going to hold that balance in accounts receivable until you get paid. So the mirror image, the opposite of accounts receivable, for those bills that you owe, where your suppliers have sold to you on credit, what are those called? Accounts payable. So in an accrual world, we have accounts like this and many, many, many others that hold balances that adjust for those timing issues. Because in the case of the floor covering guy, if he'd in fact had $70,000 worth of expenses, and then probably some other overhead as well, right? Compared to the $150,000 he got on the progress payment, but that didn't even out until March. Is he profitable? Does he know it when he needs to know it? That's the issue, and that's what accrual accounting does for you.